Welcome back to Accounting 101. In this video, we're going to be talking about Chapter 3, Adjusting the Accounts. The learning objectives for this chapter is to explain the accrual basis of accounting and the reasons for the adjusting entries. Then we'll look at the two types of adjusting entries for deferrals and adjusting entries for accruals. Finally, we'll talk about the adjusted trial balance. The real reason we have accrual basis and adjusting entries is that we divide the economic life of a business into artificial time periods. This is considered the time period assumption. Generally, it's a month, a quarter, or a year. And these are the periods that we'll be talking about mainly in this chapter, or this semester in this book. Typically a month and a year, what we'll talk about. Sometimes we'll get into multiple months to get a quarter and that type of thing, but basically it's a month and a year that we're going to be talking about. The other ways you can do it, and the company I currently work for, we have months, but it's not calendar months. We call it a 4-4-5. So 4 weeks in the first month of the quarter, 4 weeks in the second month of the quarter, and then 5 weeks in the third month of the quarter. And we do that for the year. So it just kind of tries to be consistent reporting periods, whereas if you have January is 31 days, February 28, March 31, you're going to get some differences in the number of working days, the number of days you are open to sell things, and that type of thing. So there's some different ways that companies can divide the times into different periods, and it's whatever the company decides is best for them. The time period assumption is also called the periodicity assumption. If we look at fiscal and calendar years, monthly and quarterly time periods are called interim periods. Most large companies must prepare both quarterly and annual financial statements. In the U.S., a publicly traded company has to report quarterly earnings. So they're going to report every quarter, they're going to report their earnings. This is something that's been in the news recently, here in the fall of 2025, where some politicians are speaking out against the quarterly reporting. IFRS companies report twice a year, so they don't have the quarterly reporting. They just do a half year and a full year. A fiscal year is an accounting time period that is 1 year in length. Okay, so if you're following the calendar months as your reporting periods, then a fiscal year will equal a calendar year. When I spoke about my company that does the 4-4-5, just 4 of those periods, or those grouping of periods, will equal a fiscal year. So there can be slightly different time periods between a fiscal year and a calendar year. And of course, the calendar year matches the calendar, January 1st to December 31st. And here's an example graphically. So each month, and we assume that these match the calendar months, these accounting periods. Interim periods are each of the months, so there's 12 periods. There's 4 quarterly periods, another interim interim period. So the 4 quarterly ones are interim as also. And then on December 31st, it's the end of the fiscal year, which happens to match the calendar year. This is typical. You'll see this quite a bit. Different industries will adopt different year ends. So a lot of retail companies don't have December 31st as their year end. It's either January or sometimes into February. So it's off a little bit from the calendar year. The reason for that for the retail is November, December are big sales periods. leading into the holidays. And then January is a big return month, as people get their gifts in December. If they don't like it, wrong size, whatever, there's going to be a return. So in order to capture that into the accounting period they want it to be in, they push out their year end past the calendar year end. Companies choose it when they start their business, when they file their first annual reports and their tax returns. So they typically match what they're doing for tax periods. So you don't have to follow a calendar year. You can choose a different one. If you get into business and decide to change it, you're allowed to change it. You have to go through a process of filing documents to saying that you're changing it, and you have to restate prior periods that you've already released to show what the new periods look like. So it's a little bit of a hassle. So they don't do it all the time, but you are allowed to change it and pick what works best for your company. The time period assumption states that A, revenue should be recognized in the accounting period in which it is earned. B, expenses should be matched with revenues. C, the economic life of a business can be divided into artificial time periods. Or D, the fiscal year should correspond with the calendar year. We just discussed this, and the answer is C, the economic life of a business can be divided into artificial time periods. The first two answers there are true, and we'll talk about those in a little bit coming up. The fourth one, D, is not true. The fiscal year does not have to correspond with the calendar year. Accrual versus cash basis accounting. So in accrual basis accounting, transactions are recorded in the periods in which the events occur. So what does that mean? Companies recognize revenues when they perform the services rather than when they receive the cash. And expenses are recognized when incurred rather than when they pay the cash. Under cash basis accounting, revenues are recorded when cash is received. Expenses are recorded when cash is paid. Cash basis accounting is not conform with generally accepted accounting principles, GAAP. So in the U.S., public companies are not allowed to use cash basis accounting. Some small businesses, they may use cash basis accounting. Accrual and cash basis accounting, the differences are when the transactions are recording for income tax purposes. It's more on a cash basis, so there are some differences between tax and accrual basis accounting potentially, but you really need to take a tax class to fully understand what all those differences are. Recognizing revenues. Okay, we touched briefly on this in chapter 2, and we saw some examples of companies getting in trouble with revenue recognition or not being able to appropriately recognize the revenue. Revenue recognition is or can be, depending on the type of business, a complicated function. There's a lot of guidance that's put out for both IFRS and US GAAP, and it seems to be changing constantly. So as new businesses come in, new business models are happening, the way you recognize revenue is changing. So a lot of the examples we're going to go through in the class are simpler, so we don't get into a lot of the detailed calculations and the concepts, but we do talk about revenue recognition. Okay, the key is that you recognize the revenue when the performance obligation is satisfied. Okay, not when the cash uh, is changes hands, but when the performance obligation is satisfied. Okay, so here's an example graphically. Customer requests service, service is performed, at a later time cash is received. The revenue recognition is when the service is performed, and the company that is performing that service has no further obligation. Okay, and we'll go through some examples of how we do that. 5 steps in revenue recognition. Identify the contract with the customers, so the agreement between the two parties of what is supposed to be performed, whether a service or delivering of goods. Identify the separate performance obligations. So in our example, Sierra has only one performance obligation to provide guide services. If they agreed to also sell camping equipment, that's a separate performance obligation for that promise, and there could be different revenue recognition timing. Determine the transaction price. So it's the selling price or the price of the services in this case. The transaction price here, we're going to say is $1,500. So they're charging $1,500 to provide the guide service for a particular trip. Number 4, you allocate the transaction price to the separate performance obligations. So if there were more than one obligation within the transaction, for example, guide service and camping equipment, you would allocate the price, the $1,500, to both of those. In this case, they only have one performance obligation to provide the guide services, so it all goes to that. And then finally, recognize revenue when each performance obligation is satisfied. So once the guide trip is complete, that's when Sierra can recognize the $1,500 revenue for this contract. Expense recognition principle. Match expenses with revenues in the period in which the company makes an effort to generate those revenues. Okay, that's a little bit confusing potentially, but an easy way to think about it is let the expenses follow the revenues. Okay, so some of the expenses we might have: advertising, delivery, utilities. Okay, we incur those costs. When do we recognize those as expense on our financial statements? We recognize those in the period in which they're used to generate revenue. So if we have a storefront, for example, and we're paying utilities, if we're open during the month of March and we're paying utilities for March, and people are coming into our storefront to buy goods or services, whatever we're selling, we recognize the utilities expense for the month that we use those utilities. And here's kind of a summary, some principles and assumptions. The time period assumption: we divide the economic life of the business into our artificial time periods. We look at revenue and recognize revenue in the period when the performance obligation is satisfied. We look at our expenses and recognize expenses in the period that the efforts were made to generate revenue. And together, their revenue and expense recognition are in accordance with generally accepted accounting principles. Another review question: which one of the following statements about the accrual basis of accounting is false? Events that change a company's financial statements are recorded in the periods in which the events occur. Revenue is recognized in the period in which the performance obligation is satisfied. The accrual basis of accounting is in accordance with generally accepted accounting principles. Revenue is recorded only when cash is received, and expenses are recorded only when cash is paid. Again, the question is, which one of these is false? The answer is D. Revenue is recorded only when cash is received, and expenses recorded only when cash is paid. That is cash basis, so under accrual basis, that is false. Here's an example from Apple, thinking about when their performance obligation is satisfied. So at one point, Apple was required to spread the revenues from their iPhone sales over a 2-year period following the sale of the phone. You think, well, wait a minute, they delivered the phone? Isn't that done? They don't have any further performance obligation. But the accounting standards required this because Apple was obligated to provide software updates after the phone was sold. Since they had service obligations after the initial date of the sale, they had 2 years that they were guaranteed or guaranteeing that they would send these updates. Sometimes they went beyond that, but the 2-year period was what they had to recognize the revenue over. The rapid growth of iPhone sales was not fully reflected in the revenue amounts reported in Apple's income statement. A change in accounting standard, however, and I told you they continue to change, so it evolves. That enables Apple to report much more of its iPhone revenue at the point of sale. It was estimated that under the new rule, revenues would have been about 17% higher and earnings per share almost 50% higher years ago when they were under the old rules compared to what the new rules were. Why was it argued that Apple should spread recognition of iPhone revenue over a 2-year period rather than upfront? The promise to provide software updates because of this represents an unfulfilled performance obligation. It was argued that Apple should spread its revenue over the 2-year estimated life of the phone. Okay, because they had that additional obligation, they had to record the revenue over that 2-year time period. Adjusting entries. Why do we need them? Okay. Well, we talked about the revenue recognition and expense recognition principles. So in order to make sure that those are being followed correctly, we need adjusting entries. Necessary because the trial balance may not contain up-to-date and complete data. And it's required every time a company prepares financial statements. And here's a key for adjusting entries as you're learning, doing examples, and doing your homework and on the exams and quizzes. An adjusting entry will include one income statement account and one balance sheet account. Okay, so if you come up with an entry as you're looking at adjusting entries and you think it should include 2 balance sheet accounts or 2 income statement accounts, it's probably either 1, not an adjusting entry, or 2, you've done something incorrect. So rethink about that. There are times when we do entries that are doing 2 income statement accounts or 2 balance sheet accounts, but most of those are then correcting entries as opposed to adjusting entries. So if you're thinking just about adjusting entries or accruals and deferrals that we're talking about in this chapter, 1 income statement account, 1 balance sheet account. Adjusting entries are made to ensure that A, expenses are recognized in the period in which they are incurred, B, revenues are recorded in the period in which services are performed, C, balance sheet and income statement accounts have correct balances at the end of accounting period, or D, all of the above. Just as we learned, the answer is D, all of the above. There are 2 types of adjusting entries. There are deferrals and accruals. Okay, what are deferrals? Deferral can be a prepaid expense. So that is expenses paid in cash before they are used or consumed. So we talked briefly about that again in chapter 2. We'll get more into what that is in this chapter and how you really calculate and look at those. Unearned revenues is another deferral. This is where cash is received before services are performed. Okay, so a customer pays a deposit or they pay something up front. Think about an airline ticket. You're typically not buying the airline ticket as you're stepping on the flight. You're buying it weeks or months in advance. You're giving your money to the airline. They have an unearned revenue because until that flight happens and you're sitting on it, they cannot recognize that revenue. Accruals, so accrued revenues. So this is revenues for services performed but not yet received in cash or recorded. And accrued expenses, expenses incurred but not yet paid in cash or recorded. Most of the accruals happen close to the end of the accounting period, close to the end of the month, because if you're doing your accounting correctly, you should be recording these daily or weekly, but there are times when things happen at the end of the month that you just haven't recorded it yet, so you have to do an accrual entry at the end of the month to recognize it in the right period. A way to remember these are deferrals. Cash happens first, so a cash transaction happens before revenue or expenses are recorded. Accruals, the transaction happens first before the expense or revenue is recorded. We learned how to do the trial balance last chapter. So here's an example of a trial balance that we looked at before. At the end of the accounting period, you're going to review each account and analyze it to determine whether it's complete or up to date for financial statement purposes. Okay, so if you look through this briefly, we have supplies, prepaid insurance, equipment. Okay, those three all could have and typically have adjusting entries that we need to think about. We have unearned service revenue, so we need to look at that account to make sure we've recognized all our revenue correctly. Notes payable typically has interest associated with it, so that's another one that may be an adjusting entry. So on the left are a list of concepts, description of the concept in the right column. There are more descriptions than there are concepts, so we're not going to use all the ones from the right column, but match up column A to column B. So accrual basis accounting is F. Companies record transactions in the period in which the events occur. A calendar year. E. An accounting time period that starts January 1st and ends December 31st. Time period assumption. That is C. Accountants divide the economic life of a business into artificial time periods. And the expense recognition principle that states that expenses should be matched with the results, revenues, so B. Now we'll get into the adjusting entries for deferrals. How do we, what types are they? What do we look at? How do we record those? Okay, again, deferrals happen where cash happens first. So prepaid expenses, unearned revenues are two examples that we're going to go through. Payments of future expenses that will benefit one or more accounting period. That's a prepaid expense. Okay, so the cash payment happens before the expense is recorded. What are some common prepayments? Insurance, supplies, advertising, rent, buildings and equipment. Okay, where all of these examples, we typically pay cash first, but we don't use up the asset or use or record the expense or incur the expense until a time in the future, and a lot of times it's more than one accounting period. Adjusting entry. Okay, costs that expire either with the passage of time or through use. We're going to create the adjusting entry where we increase or debit to an expense account and we decrease or credit an asset account. Okay, so the asset has a debit balance unadjusted. We're going to put a credit to lower that asset and debit increase the expense. Adjusting entry for supplies. So Pioneer Advertising purchased supplies costing $2,500 on October 5th. Pioneer recorded the purchase by increasing, debiting the asset supplies. Account shows a balance of $2,500 in the October 31st trial balance. Inventory count at the close of business on October 31st reveals that $1,000 of supplies are still on hand. Okay, so we bought $2,500 worth of supplies in October. At the end of October, there's only $1,000 worth of supplies still on hand, so we have to do an adjusting entry. We're going to debit supplies expense, $1,500, credit supplies, $1,500. So our new balance in the supplies account is going to be the $2,500. That's a debit. Since we credited $1,500, we're going to reduce that account, so it's going to be $1,000, which is what our count showed. And here's the example that we saw again in Chapter 2, what the analysis is, the equation analysis, debits and credit analysis, create the journal entry, and then we post to the ledger, and we can see down at the bottom there, our October 31st balance for supplies was $1,000, which is what we're trying to get to because that's what the count showed. And then the supplies expense, we now have the expense of $1,500 in that account. Adjusting entry for insurance. Okay, on October 4th, Pioneer Advertising paid $600 for a one-year fire insurance policy. Coverage began on October 1st. Pioneer recorded the payment by increasing, debiting the prepaid insurance account. This account shows a balance of $600 at the October 31st trial balance. Insurance of $50 expires each month. We got the $50 by taking the total amount, $600, divided by the number of periods. So 1 year insurance policy, we have 12 periods, so we divide 600 by 12, and that's how much we get each month. So here's another example of how we got to that $50 per month insurance expense. So what's the journal entry we do, the adjusting entry? We're going to debit insurance expense, $50, credit prepaid insurance, $50. This graphic over here on the bottom right shows that each month is $50. Add up the 12 periods, we have $600 for the year. That's what we paid for the insurance policy. And again, going through the steps of the analysis, the accounting equation analysis, determining the debits and credits, and then we post to the ledger to get the balances. So in a prepaid insurance account, we started with $600, we made one adjusting entry, our balance is $550. We have 11 months to go. Another prepaid expense is our fixed assets, so buildings, equipment, vehicles, that type of thing. And depreciation is the expense that we're going to incur each month as we use that asset. So buildings, equipment, motor vehicles, they provide service for many years, record as an asset rather than expense on the date acquired. Depreciation is the process of allocating the cost of that asset to expense over its useful life. Depreciation does not attempt to report the actual change in the value of the asset. Okay, so if you have a building, buildings are very long-term assets, so 20, 30, 40 years potentially that you're going to depreciate it. So each month you're going to record depreciation expense. We're not trying to show what that building is worth if we were to sell it at any point in time, but we're trying to spread the initial cost of that building over the life of that building. Okay, and then in a future chapter we'll get into more details of how you actually calculate the depreciation. But for this chapter, we're just trying to get the concept of recording the expense of depreciation and accumulated depreciation by spreading the cost over the life of the asset. So most of the time we're going to be given what that is per month, or in some cases you're going to be given what the annual depreciation is, and you have to record it for a month. So that type of thing, but not actually how we calculate it. So in this example, Pioneer Advertising assumes that depreciation on the equipment is $480 per year. If we divide that by 12 months in a year, we get $40 per month. So for October, we're going to record an expense of $40 to depreciation expense, and we're going to credit an account called accumulated depreciation equipment. Okay, what is that accumulated depreciation equipment account? That is a contra asset account. Okay, contra accounts have increases, decreases, and normal balances opposite to the account to which they relate. Okay, so equipment is an asset. It shows up in the asset section of the balance sheet and on the trial balance. Accumulated depreciation decreases that asset, but we don't show that decrease as a direct reduction of that asset account. So unlike prepaid insurance or supplies where we credit that account directly, we're going to credit this contra asset account. So we show the initial cost, the historical cost in one account, and we show the reduction in a separate account. A little bit confusing, but no one said accounting was straightforward. So we have this new account that we're using, this contra asset account. Again, we go through the analysis, determine the debits and credits, and we post to the ledger. Okay, so if you look down here at the posting of the ledger section at the bottom, we have equipment we bought for $5,000. At the end of the month, that still shows the $5,000. So we're not going to change that just by recording the depreciation expense. But we have the depreciation expense account where we recorded the $40, and we have this new contra asset account, accumulated depreciation equipment, where we show a credit of $40. Okay, when we look at statement of presentation on the financial statements, accumulated depreciation and contra asset account, it's a credit, appears just after the account it offsets, in this case equipment. The book value is the difference between the cost and then the accumulated depreciation. Okay, so if you hear the term, what's the book value of your assets, they're looking at the cost that doesn't change year to year and the accumulated depreciation. And the way you present that is you show the cost equipment less accumulated depreciation equipment, $40. So the book value in this example is $4,960. Okay. Again, we've got another chapter where we'll get into depreciation and how you calculate it and more details about that. For this chapter, when you do adjusting entries, you just got to be aware that, yes, you do depreciate assets, you record an expense during the interim time period, so each month, each period, and that offset goes to accumulated depreciation. It's a balance sheet account, so we have one income statement account, one balance sheet account. It's a credit that shows up on the asset side. So again, there's always exceptions. We said assets have normal debit balances. Now we've got this asset account. It's a contra asset, so it's got the opposite. So here's the summary of accounting for prepaid expenses: insurance, supplies, advertising, rent, depreciation. Some of the examples we talked about. Prepaid expenses are originally recorded as assets. We've used up some of that asset, whether through actual use for supplies, for example, or use it up over time So insurance, depreciation, rent are all things that time is what we're using up of that asset. Before the adjusting entry, our assets will be overstated because we've used up that asset. We have to lower the asset, and we haven't recorded the expenses, so the expenses are understated. The adjusting entry is to debit expenses, credit the assets, or in the case of depreciation, the contra asset. Unearned revenues. Okay, it's receipt of cash that is recorded as a liability because the service has not been performed. So cash received before the revenue is earned. Examples of unearned revenues: rent, airline tickets, magazine subscriptions, customer deposits, concert tickets is another example. So again, the cash exchanges hands, the company receives the cash before their performance obligation is completed, so we can't recognize the revenue yet. So we put it in on the balance sheet, unearned revenue. Unearned revenue is a liability. The adjusting entry is made to record the revenue for the services performed during the period and show the liability that remains at the end of the accounting period, if there is any. So results in a decrease, a debit to the liability account, and an increase, a credit to the revenue account. So let's look at an example. Adjusting entry for unearned revenue. Pioneer Advertising received $1,200 on October 2nd from R. Knox for advertising service expected to be completed by December 31st. Unearned service revenue shows a balance of $1,200 in the October 31st trial balance. Analysis reveals that the company performed $400 of services in October. Okay, so graphically we have this example. Customer pays $1,200 on October 2nd. Company says, we'll finish your advertising campaign or services that we're providing by December 31st. Cash is received, liability is recorded for Pioneer. During October, we've performed some services. We've completed some of that obligation, so we can recognize some of that revenue. In this case, we're saying that we can recognize $400 of revenue. So we either have done analysis or we said we're going to do it equally over 3 months, October, November, December, all be 400. Regardless, the entry is unearned revenue, unearned service revenue debit $400, so we're decreasing that liability, and credit service revenue $400 to recognize that revenue. So again, the steps we go through, we do the analysis, we think about the accounting equation analysis, we determine the debits and credits, record the journal entry, and post it to the ledger. Okay. Unearned revenue is a liability. We've mentioned that. It shows up in the liability section of the balance sheet. It's under the liabilities in the accounting equation. It's a liability because if we do not perform the services, in most cases we have to provide that cash back to the customer. They're going to demand that they get either the services they paid for or they get their money back. So it's a liability to us as a company that we have an obligation either to perform the services or provide the money back. Accounting for unearned revenues. Again, examples: rent, magazine subscriptions, customer deposits for future service. The reason we do the adjustment: unearned revenues recorded in a liability account are now recognized as revenue for services performed. Before the adjusting entry, liabilities are overstated and the revenues are understated. So we've completed a performance obligation but haven't recognized the revenue. So our revenues are understated. We need to record that. And the adjusting entry is to debit liabilities, the unearned service revenue, and credit the revenues. Gift cards. So this is a Best Buy example. So gift cards are among the hottest marketing tools in merchandising today. Okay. If you go into just about any store, you're going to see a display case with all kinds of gift cards. Okay. Customers purchase gift cards and give them to someone for later use. In a recent year, gift card sales were expected to exceed $160 billion. So that's a lot of cards out there. These programs are popular with marketing executives. They create accounting questions. Should revenue be recorded at the time the gift card is sold or when it is redeemed? How should expired gift cards be accounted for? In the balance sheet for the year ended February 1st, 2020, Best Buy reported unearned revenue related to gift cards of $281 million. So they have sold $281 million worth of gift cards that had not been used. So they have that liability still on their books for $281 million. Oops, went ahead too far. Suppose that Tyler Palmer purchases $100 gift card at Best Buy on December 24th, 2026, and gives it to his partner, Anisha Jain, on December 25th, 2026. On January 3rd, 2027, Anisha uses the card to purchase a smartphone speaker worth $100 at Best Buy. When do you think Best Buy should recognize revenue and why? So we're going to look at the accounting issues in this problem, not the problems that Tyler went out on Christmas Eve and bought a gift card to give to his partner on Christmas Day. According to revenue recognition principle, companies should recognize revenue when the performance obligation is satisfied. Okay, we saw that earlier in this chapter, so that's the kind of the bar that we look for recognizing revenue. So in this case, revenue results when Best Buy provides the goods. Thus, when Best Buy receives cash in exchange for the gift card on December 21st, it should recognize a liability. Unearned sales revenue for $100 on January 3rd, when Anisha Jain exchanges the card for merchandise, Best Buy should recognize revenue and eliminate the $100 from the balance of the unearned sales revenue account. The other thing that I think about when trying to determine, how do we record this is Best Buy is in the business of selling electronics and appliances, software, printers, that type of thing. They're not in the business of selling gift cards. Okay, if they were in the business of selling gift cards, that would be their performance obligation, is to sell a gift card. But they're in the business of selling electronics and associated things with that, so they recognize the revenue when that performance is obligated. Okay, so that's just something that how I think about this and how I think about, is it revenue or is it a liability? And we went through this already. So, okay. Adjusting entries for deferrals. The Ledger of Hammond Incorporated on March 31st, 2027 includes these selected accounts before adjusting entries are prepared. So we have prepaid insurance, we have supplies, we have equipment, we have accumulated depreciation equipment, and we have unearned service revenue. Okay, so this isn't the full trial balance. It's just the accounts that may need an adjusting entry because we have these assets and liabilities on our books. So we need to analyze these, and as we do the analysis, we see that insurance expires at the rate of $100 per month. We have supplies on hand that total $800, and the equipment depreciates $200 a month. During March, services were performed for $4,000 of the unearned service revenue, and we need to prepare the adjusting entries for the month of March. So the insurance. If insurance expires at the rate of $100 per month, We're going to debit insurance expense for 100, credit prepaid insurance for 100. So in this example, they tell us what the rate of insurance is per month, the $100. So we don't need to calculate anything. Another way they could present this is to say that the $3,600 prepaid insurance balance represents 36 months of insurance, so 3 years. We would have to do then the calculation of 3,600 divided by 36 to get the $100 per month. So just be aware of what the question is asking and the information that is given. So you either have to do a calculation to determine how much per month you need to record, or it's going to tell you how much per month, and you don't have to worry about the length of the insurance policy. Supplies on hand total $800. Okay, so we have supplies on our balance sheet and our trial balance of $2,800. We only have $800 left, so that means we need to do an adjusting entry for $2,000, the $2,800 minus the $800. So we're going to debit supplies expense $2,000, credit supplies $2,000. Again, prepaid expenses on supplies especially, it's either going to tell you what is left, so in this case $800, and you have to determine what the adjusting entry is by comparing that to what is on the trial balance before the adjusting entry, or they could tell you that we could have said the supplies that were used in the month of March equal $2,000. In that case, you don't have to do a calculation. You just get that $2,000 and record that. So again, be aware of the information they're giving and what they're asking for to determine how you need to calculate it or not calculate it. The equipment depreciates $200 a month. So to record depreciation expense, we debit depreciation expense, the $200, credit accumulated depreciation equipment for $200. Again, in this chapter, it's probably going to tell you what the depreciation is. It may tell you, like we saw in an earlier example, how much it is for the year, and then you have to divide that by 12 to get it for the month, or it's just going to tell you how much per month. Another chapter later in the semester, we'll talk about how you actually calculate that amount. Finally, during March, services were performed for $4,000 of the unearned service revenue reported. Okay, so it's telling us that of the $9,200 liability we have, we've performed our obligation for $4,000 worth of that. So we're going to debit unearned service revenue $4,000, credit service revenue $4,000. So that's the deferrals. Okay. Next, we'll talk about accruals. Okay. Accruals are made to record revenues for services performed but not yet recorded at the statement date. So accrued revenues, or expenses incurred but not yet paid or recorded at the statement date, accrued expenses. Okay. So revenues, accrued revenues, they're services performed, not yet received in cash or recorded. So the service is performed before cash is received. Examples: rent, interest, services performed. Okay. An adjusting entry for accrued revenues records the receivable that exists at the balance sheet date and the revenue for services performed during the period. So the adjusting entry increases, debits, an asset account, accounts receivable most likely, and increases or credits a revenue account. So here's an example: Pioneer Advertising. They performed services worth $200 that were not billed to clients in October. What's the adjusting entry? We're going to debit accounts receivable $200, credit service revenue $200. Okay, so the key here is that they performed the services that were not billed. So They looked at December 31st or October 31st, sorry, and they said, all right, what have we done month, during the month of October? How much have we billed to customers? How much haven't we billed yet? We're going to bill them eventually, but we didn't do it within the accounting period. So we do an adjusting entry to record that service revenue in the correct accounting period, in this case, October. Now on November 10th, the Pioneer receives cash of $200 for the services performed in October. That entry is to debit cash because we received cash and credit the accounts receivable. So we no longer have that asset accounts receivable. It got turned into cash because the client or the customer paid us for that. So this is where we've recorded the revenue in October. That's the month that we performed the services. Cash was received the next month. And when we receive that cash, we don't record the revenue. We've already recorded that revenue. We record it against the asset accounts receivable. And again, here's the steps we've gone through. We analyze the transaction. We look at the accounting equation. We determine the debits and credits, and then we post it to the ledger. What do we do with accrued revenues? So interest, rent, services are examples. The services are performed but not yet received in cash or recorded. Okay, that's the key, not recorded yet. Assets are understated, revenues are understated if we don't do the adjusting entries. And the adjusting entry is to debit assets, credit the revenues. Next, we'll look at accrued expenses. So expenses incurred but not yet paid in cash or recorded. So the expense is recorded before the cash payment. Examples of accrued expenses are interest, utilities, taxes, salaries. Okay, those are all common examples of we may not have an invoice. In the case of salaries, the pay period may not, and the pay date may not end up exactly with the end of the accounting period, end of the month. So those are things that we may have to accrue the expense for. The adjusting entry records the obligation, the liability, and recognizes the expense. So the adjusting entry is to increase or debit the expense account and increase or credit a liability account. Accrued interest. So Pioneer Advertising signed a 3-month note payable in the amount of $5,000 on October 1st. The note requires Pioneer to pay interest at an annual rate of 12%. So a note is a loan, a type of loan. So they received $5,000 cash for their business. They're going to pay 12% annual interest rate. So each month they're going to record the interest that they're incurring, even though they may not be paying that interest. So to calculate the interest, take the face value of the note, $5,000, times the annual interest rate, 12%, times time in terms of a year, 1/12, equals $50. We have another chapter on liabilities where we will look at this in more detail, this equation, and get into more of how it works and that type of thing. The key is that if it gives you what the annual rate is and you need it for a month, you take the annual interest rate times 1/12 times the face value to get the interest. I think most of the examples, they give you what the interest is or give you a way to do it. The entry we record is to debit interest expense for the $50, credit interest payable for the $50. So we're going to pay that interest in the future, so we set up the liability. And the steps that we went through, analyze the equation, or analyze the transaction, the accounting equation, debits and credits, create the journal entry, and then post the journal entry to the ledger. Accrued salaries and wages. Okay. Pioneer paid salaries and wages on October 26th for 2 weeks, October 15th through October 26th. The next payment of salaries will not incur until November 9th. Employees receive total salaries of $2,000 for a 5-day work week, or $400 a day. Thus, accrued salaries at October 31st are $1,200, so $400 per day times 3 days. Accrued salaries and wages is very typical. Most of the time, the pay period does not equal or does not end on the end of the month. Sometimes they do, but a lot of times they don't, especially if you pay employees weekly, or in this case for 2 weeks at a time. It's not going to fall exactly at the end of the month. In this case, October 31st is on a Wednesday. If we're paying them by week, we typically end that on a Friday. Okay, so we need to know how much pay is earned each day. So in this case, they gave us total salaries for a 5-day work week. We divide that by 5 to get it by the number of days. Sometimes the problems may tell you what each person earns a day and the number of people. So then you have to multiply the amount per person by the number of people times the number of days. But the concept is still the same. Is how many days is the adjustment period? So how many days into the pay period we are at the end of the month, and then make the adjusting entry. I think looking at a calendar kind of helps figure that out. Sometimes they don't tell you what the month is, or how many days, or they'll tell you how many days are unpaid versus giving you the dates, the calendar dates. So again, read what the information they give you, try to figure out what they're asking for, and just think through the problems. So analysis, we've identified that $1,200 of salaries and wages is not recorded, but the employees have worked. So we look at the accounting equation, we determine debits and credits, we do the journal entry, debit salaries and wages expense for $1,200, credit salaries and wages payable, the liability account for $1,200, and then we post those to the accounting ledger. So again, examples of accrued expenses: interest, rent, salaries. The reason we do it: expenses have been incurred but not yet paid in cash or recorded. Before the adjustment, expenses will be understated and liabilities will be understated. The adjusting entry is to debit expenses, credit liabilities. And then another ethics report here. Report released by Fannie Mae's Board of Directors stated that improper adjusting entries at the mortgage finance company resulted in delayed recognition of expenses caused by interest rate changes. The motivation for this accounting apparently was the desire to hit earnings targets. So they didn't want to show higher expenses, which would lead to lower earnings. So they delayed some of that recording. They understated their expenses, which overstated their income. Here's a summary of what we went through of the types of adjustments and what is wrong with the accounts before the adjustments. So you can read through those, and then what the adjusting entry is. Okay, this is a pretty key summary, or a good summary to help you remember what needs to happen. So, I would look to review this multiple times as you're going through, or keep it handy as you're going through and doing the homework and as you're studying for the exams, because this will be is a good summary to help you. And then here's the adjusting entries we went through for Pioneer all together. So they're all listed there. One thing to note as we went through this, we kind of touched on it but didn't call it out specifically, is that the date of the adjusting entry is the last day of the month, the last day of the period. So all these are dated October 31st. And when we post to the general ledger, and we post them to the ledger accounts, we've highlighted in red everything that has been adjusted. And here's the rest of them. And again, we talked about it earlier, but adjusting entries will always be one income statement account and one balance sheet account. The other thing that we didn't talk about but is key is that it will never be cash. Okay, even though that's a balance sheet account, if you're adjusting cash or thinking that cash should be used in an adjusting entry, that is not correct, because cash has already exchanged hands on deferrals, or cash is going to change hands later in the case of deferrals. So you never use cash in an adjusting entry. So we'll go through some more examples. Microcomputer Services began operations on August 1st, 2027. At the end of August 2027, management prepares monthly financial statements. The following information relates to August. On August 31st, the company owed its employees $800 in salaries and wages that will be paid on September 1st. August 1st, the company borrowed $30,000 from a local bank on a one-year note payable. The annual interest rate is 10%. Interest will be paid with the note at maturity. Revenue for services performed but unrecorded for August totaled $1,100. We need to prepare the adjusting entries needed at August 31st, 2027. So the first one, the company owed its employees $800 in salaries and wages that will be paid on September 1st. So what's the adjusting entry for unpaid salaries and wages? We're going to record the expense, so we're going to debit expense $800, so salaries and wages expense debit $800. We're going to set up the liability, in this case salaries and wages payable. We're going to credit that $800. So in this example, they gave us how much was owed. We didn't have to calculate the number of days or anything like that. It just told us what the total was. But be aware that some of the questions may say the number of days and the amount, the number of days, the number of people, that type of thing. Okay. The next one, the company borrowed $30,000 from a local bank on a one-year note payable. The annual interest rate is 10%. Interest will be paid with the note at maturity, which means that the interest will be paid at the end of 1 year. When we pay back the $30,000, we'll add the interest to it. First, we have to calculate what the interest is. Remember, it's the face value times the annual interest rate times the time. So 1/12 in this case, it's 1 month. So 30,000 times 10% times 1/12, $250. How do we record that expense? We're going to debit interest expense $250. Credit the liability interest payable $250. And the third one, the revenue for services performed but unrecorded for August totaled $1,100. Okay. So we're going to debit accounts receivable $1,100, setting up that asset. The customer owes us that amount of money, so that's an asset to us, and record service revenue $1,100. Okay, next we'll go into the nature and purpose of an adjusted trial balance. So the adjusted trial balance is prepared after all adjusting entries are journalized and posted. Purpose is to provide or prove the equality of debit balances and credit balances in the ledger after all adjustments. And it's the primary basis for the preparation of financial statements. Okay, again, the purpose of a trial balance is to prove debits equal credits. It does not mean that all the transactions were recorded correctly. It does not mean that all the journal entries were posted correctly to the ledger. It just simply says, if I look at the ledger balances for each account, do my debits equal credits? Okay, we're going to assume that we've recorded everything and that we've posted to the ledger correctly. So then we're going to use that for our financial statements. But again, it simply proves that debits equal credits. So here's the unadjusted trial balance. We looked at that in the previous chapter and how we do that. If we look at the adjusted trial balance, you see that we have different balances in certain accounts. We've added some accounts that weren't on the trial balance before because we hadn't recorded any entries into those accounts. So if we go back again to the unadjusted, okay, if you look down at the bottom, our revenues and expenses, we have one service revenue account, we have two expense accounts. If we look at the adjusted trial balance, we still have only the one service revenue account, but the dollar amount has changed because we've done an entry to that. Our salaries and wages and supplies expense has changed. And then we have three new expense accounts: insurance expense, interest expense, depreciation expense, that were not on the trial balance before we did the adjusting entries. The adjusted trial balance. Which of the following statements is incorrect concerning the adjusted trial balance? Is it A, an adjusted trial balance proves the equality of the total debit balances and the total credit balances in the ledger after all adjustments are made? B, the adjusted trial balance provides a primary basis for the preparation of financial statements. The adjusted trial balance lists the account balances segregated by assets and liabilities. Or the adjusted trial balance is prepared after the adjusting entries have been journalized and posted. So which of these is incorrect? And that is the adjusted trial balance lists the account balances segregated by assets and liabilities. Okay, we may have it in that order, but it's not segregated, so we don't have a total assets and total liabilities. Okay, that would be the balance sheet. So even though they may be listed in order or grouped by assets and liabilities, they are not segregated by those. Preparing the financial statements. Financial statements that are prepared directly from the adjusted trial balance are the income statement, the retained earnings statement, and the balance sheet. Okay. Chapter 12, the last chapter, we talk about cash flow statement and how we prepare that. That's the fourth financial statement we talk about in this class, but that is not prepared directly from the adjusted trial balance. Some more intricacies that we have to go through and an analysis we do to prepare that, so we put that in a separate chapter. So how do we prepare financial statements from the trial balance? So here's an example. If we look at the trial balance, we have the common stock retained earnings, dividends. The retained earnings and dividends go into the retained earnings statement. The ones that are in red there, the service revenue and all the expenses, go into the income statement. So we take the service revenue and put it in the revenue section of the income statement. The expenses we list in the expense section of the income statement. Subtract our expenses from our revenues, so revenues minus expenses equals our net income. Net income is then used into the retained earnings statement. We also take the beginning retained earnings from the adjusted trial balance for beginning retained earnings, in this case 0. We add our net income. We subtract our dividends, which we get off the adjusted trial balance, to get our retained earnings on October 31st. We're going to take that over to the balance sheet on the next slide. We also look at our assets and our liabilities. So cash through accumulated depreciation equipment is our assets. So we show that on our balance sheet. We add those up, we get a total assets, $21,910. We take our liabilities, put those in the liability section of the balance sheet to get a total. Take our common stock, put that in the stockholders' equity section, and we have our ending retained earnings that we got from our retained earnings statement in the previous slide that we looked at. We add those together to get total stockholders' equity, add that to our total liabilities, and our total liabilities to stockholders' equity is $21,910. So our assets equal our liabilities plus stockholders' equity. That's our accounting equation, and it shows our balance sheet. Okay, again, we talked about it last chapter, underlines, dollar signs, that type of thing. We put a dollar sign on the first amount in a column. We show underline where we are summing or getting a total. And then when we have a total amount, a final total amount, we have the double underline. So the same concepts, but now it's just in the financial statements. So this company, and I'm not going to attempt to say that name of that company because I'll butcher it. So it was organized on April 1st, 2027. The company prepares quarterly financial statements. The adjusted trial balance amounts at June 30th are as follows. So we have the adjusted trial balance amounts. We show this in two different columns. Instead of one listing with the debit and credit column, we show our debit balances in one column. We show our credit accounts in a separate one. So we're going to determine the net income for the quarter, April 1st to June 30th, determine the total assets and total liabilities at June 30th, and then determine the amount of retained earnings at June 30th. Okay, so something to note here. They organized on April 1st. April is the fourth month, so we have a quarter from April 1st to June 30th, 3 months. That's our quarter. We're talking about the quarter in this example, not just a month. Okay, so it's just pointing out we have different time periods that we can do things for. Luckily, we're starting with the adjusted trial balance, so we don't have to worry about the adjustments for the quarter. There may be some homework questions that say you do it for the quarter. So instead of doing it for just 1 month, you have to do it for 3 months. So just be aware of that. All right, so determine the net income for the quarter, April 1st to June 30th. How do we determine net income? We take our revenues minus our expenses. So if we look at our adjusted trial balance, do we have any revenue accounts? We do. I see 2 of them there. We have service revenue and we have rent revenue. Okay, so 2 separate revenue streams. We have 2 separate accounts for those, so those are going to be on our income statement. What else goes on the income statement to determine net income? It's our expenses. So if we look for expenses, I see 6 expense accounts. So salaries and wages, rent, depreciation, supplies, utilities, interest. So if we create an income statement, we have our revenues, we total those up to get total revenues of $15,000. We list our expense accounts, total those up, total expenses are $12,500. Revenues minus expenses, our net income is $2,490. Okay, I'm going to flip back. We're going to look at B, determine total assets and total liabilities. Okay, so what are our asset accounts? Assets have a debit balance. Remember, debits are expenses, assets, and dividends. So a good way to start is to look at our debit side of our trial balance. So we used our expenses already. Dividends is a debit, but dividends are not part of assets. So everything else are our assets. So cash, accounts receivable, prepaid rent, supplies, and equipment. Okay. We learned about a new account in this chapter, the contra asset account, accumulated depreciation. So that has a credit balance, so it shows up on the credit side, but it actually belongs in the asset section of the balance sheet. So when we calculate total assets, we have to make sure we include that. Liabilities have credit balances. Most liabilities have the word payable in it. So we look at those. So notes payable, accounts payable, salaries and wages payable, interest payable. Those are all liabilities. We have an additional liability account we learned about, unearned rent revenue. So unearned revenue is a liability account. So those are our liabilities. So if we add up our assets, add up our liabilities, this is what it looks like. So we have total assets of $23,350. We have total liabilities of $7,460. Okay. If we just have this information, we could calculate what our total stockholders' equity is. So it's just the difference because we know that assets equal liabilities plus stockholders' equity. If we had no total liabilities, we know total assets. The difference is our total equity. Okay, that's not what was asked. If we go back here, what was asked is determine the amount of retained earnings on June 30th. When we think about the retained earnings statement, it's beginning retained earnings plus net income less dividends is ending retained earnings. So if we look at our adjusted trial balance and look for a retained earnings account, I don't see a retained earnings account because we started our business April 1st, and this is for the quarter ended June 30th. We don't have a beginning retained earnings. Okay, so our beginning retained earnings is going to be 0. Calculated net income, and I did see a dividends account there, the 600. So if we take 0 beginning plus our net income, 2,490, less our dividends of 600, our ending retained earnings is 1,890. That's the end of chapter 3. That was a lot, I understand. But reviewing what we talked about is the time period assumption, so creating artificial or time periods to record transactions in. We talked about accrual basis accounting and why we do it versus the cash basis accounting. We talked about deferrals and accruals and how we account for those. Once we record those adjusting entries, post them to the ledger, we can create a adjusted trial balance. And then from the adjusted trial balance, we can create our income statement, our statement of retained earnings, and our balance sheet. So review the material. There's some good things on Blackboard to help you review that. Look at the notes and those types of things as well. If you're struggling again, reach out to the tutoring center, get some tutoring help, email me, and we can talk about ways that can help you. All right, that's it. Thank you.